Good evening and welcome to Your Money, Your Call. I'm Mark McCarthy. If you've got a question about shares you'd like answered, please give us a call. Our phone lines are now open and the number to call is 1300 30 34 35, or if you prefer you can email us at yourmoney@skynews.com.au. Tonight I'm joined in the studio by Howard Coleman from Team Invest and Tim Kelley of the Montgomery Fund. Welcome to the program. Well, gents, just when you thought it was safe to get back in the water, ever since the US election we've seen global equity markets backtrack and give up some of those hard-fought gains we saw in the prior weeks, at least anyway. Is it time to take some money off the table, or is it time to get back in? Tim, what do you think? Howard makes a good call there where he says that the stock market's the only place where there's a sale on, the buyers tend to run away.
Mark, we're not too far removed from Howard in terms of his philosophy. We perversely get excited when things become cheap because it's a long-term opportunity. At the moment, our view is probably that the market is not wildly overvalued nor wildly undervalued, so it's a reasonable time to be looking for good quality companies at a discount to intrinsic value in the long term. We think that strategy will do. All
right, let's go to our first caller, and it's James from Victoria. James, are you there?
Yeah, hi. Hi, guys. Just got a question. I've set up my own super fund.
Yep.
And I was thinking about investing in a number of stocks, but I'm sort of leaning towards, I picked up 4 stocks, Australian Foundation, Argo Investments, Derrijay, Milton Corporation. They basically invest on your behalf.
Right.
And you get about 5.5% fully franked dividends, and these companies have been around for a lot of years.
Yep.
I guess my question is, what do you think of that idea, and have I sort of missed a company outside of those ones I've just said?
I think you covered half the field, so we should be right there.
You know the type of companies I'm talking about.
Yeah. You're talking about exchange-traded funds and the like. Would that be correct?
Well, I'm not sure their technical name, but yeah, Argo Investments, AFI, Derrijay Investments.
Okay, let's go to Tim and get his views on exchange-traded funds and these particular stocks. What do you think?
James, I'm not sure I can add a lot to your thought process here. These businesses, they're listed investment companies, so they're effectively fund managers. So they do pretty much what we do at Montgomery. They look for investment opportunities. They invest on your behalf. We don't look at these sorts of investment opportunities because our job is to actually find the underlying companies themselves. What I would say is that you've chosen long-standing LICs that I think have a pretty good reputation in the market. What you need to think about is your view on the likely future investment performance of those managers, and you can look to their track record to get some guidance on that. And you should look at the fees that they're charging, and finally you should look at whether these businesses are trading, or these companies are trading at a discount or a premium to their underlying asset backing. If they're trading at a material discount to the underlying investments that they hold, then that's often an opportunity to get into them at a good price. If they're at a premium, then you're probably paying more than the underlying investments are worth.
Let's go to Matt from Darwin. Matt, are you there?
How you going there, panel?
Well, thanks, mate. How are you?
Not bad. Thanks for taking my call. Look, just a question. Views on the code is RWD Reward Minerals.
Yep.
It's a potash explorer. Just more, not really the company, I guess, more just their thoughts on the actual industry, potash as a whole, because I think it's sort of taken off soon. That's all about agreeing with that.
Yeah, good question actually there, Matt, because potash was certainly in the headlines 18 months ago with BHP looking to buy the Canadian miner there, and it was resurfaced again a couple of weeks ago as well. Potash. Tim, you look like a potash expert.
I'm not sure what's given you that impression, mate. Matt, this is a business that we've never looked at Montgomery. It's never made a profit. It's an explorer, so it's got some way to go before it develops a resource and starts to make money. So we're unable to value it, and as a principle, we avoid these sorts of businesses because they tend to be a bit like lottery tickets. Everyone hears the stories of the ones that discover something and do well, and your impression of how good these are as investments is shaped by the fact that you hear those positive stories. What you don't hear is the countless other examples that sink without trace. And our view is that on average, investors don't do well buying this sort of a business, and so it's not something that we look at.
Let's go to Robert from Sydney. Robert, are you there?
Yes, Mark. Hi.
Hi, how are you?
I just want to get the panel's opinion on a stock, FKP Property Group, and you in particular. I just want to bring to your attention the type of trading that's going on in not only this stock but hundreds of stocks. I'm finding that when I'm trying to sell a stock, particularly in the auction, you put your order on to try to get out for whatever reason, whether you have to settle or whatever, and you put them on just a tick under, and miraculously you get the lower price. If it, say, closes at 21 cents,
yep,
you get filled at 20.5, and it goes over by just 2 or 3 shares.
Yep.
And alternatively, when you're buying, you pay half a cent more. How is this happening all the time?
Tim, let's look at FKP there. I think that chart speaks for itself. Not looking too good at the moment. I don't know whether Robert's actually in or not.
Yeah, it sounded, Robert, like you were trying to exit FKP, and I certainly wouldn't discourage you from doing that if you're in it. It's a business that has it hasn't achieved a reasonable return on equity for some time. It has negative accounting earnings, negative cash flows, a high level of debt. It's a long way from a business that we would be advocating you should look at owning.
Let's go to our first caller, and we have Richard from Sydney. Oh, sorry, Richard from the Gold Coast. Richard, are you there?
I am, yes.
Hi, fire away.
My question is Rio Tinto. I think Morningside and Deutsche Bank at least have them as a buy and a fair market value of around $86 to $90, and at 56 at the moment they seem cheap, and I think they're trading a multiple of something like 9 or 10. What is your view of the share price? Say up to the end of 2014 of holding on to those shares.
Okay, well, let's go to Tim first off. I guess, Tim, the big question for Rio and all the big miners is going to be the outlook for commodity prices, and I guess, earlier with China as well, that are they slowing down? Are they not? Iron ore prices did take a bit of a spanking over the last few months, but they have bounced back. They were up at 120 last week. I haven't seen them the last couple of days. What's your take on iron ore and, in particular, Rio?
Yeah, absolutely. The critical issue in valuing a business like this is, what you think the commodity price outlook is, particularly for iron ore. And our view on iron ore is a bit more pessimistic than the market generally. It's enormously hard to say with confidence what the macroeconomic drivers will look like over any period of time. But our sense is that there's been a tremendous amount of investment in China, perhaps beyond the level that can be sustained by the urbanisation and economic development. And in particular, we think that those parts of their economic development that are really reliant on iron ore, the bulk of that may be behind them, or reliant on steel. We think that China may continue to grow, but it will be a less steel-intensive growth, even if it does continue at a healthy rate. So we're not buyers of Rio Tinto at the current price. Let's go to Sandy from Queensland. Sandy, are you there?
Yes, I am. Thank you for taking my call.
Yeah.
I love your show. I've got a couple of questions, but the first one actually is Energy Action, which is EAX, and I'm probably talking more to Tim than to Howard, but I'd love both comments, please.
Sure, certainly. Yes, and was there something else, Sandy?
Mastermind, MYE, if you have time.
Okay, let's have a quick look at Energy Action first off. Tim, is this one that you're familiar with?
Sandy, this is one that we have had a look at over the last little while. It's a business that has generated strong profit growth and some good financial performance. The business that they're in is managing a reverse auction for power supplies, effectively. So a small business may get Energy Action to arrange for them the best possible utility deal, and it's an interesting business. It's one that we haven't bought because we're struggling a little bit with exactly how to value it and what its prospects might be. But it's certainly an interesting business. And one that we'll be sort of watching as it goes forward. It's still at a very early stage. It's got a capitalisation of $67 odd million, but if its business model, if it's successful in delivering that business model, it's potentially a very interesting business going forward.
Okay. Let's go to Michael from the ACT. Michael, are you there?
Yes, good evening. My stock tonight is Telecom New Zealand. Does the panel have an opinion on it?
Downward note, Tim. Any silver linings in the clouds there?
No, I've got no disagreement with Howard on this one. It's a business that has declining cash flow over time, and I think it's facing some pretty tough competition. I think whereas Telstra has a very strong competitive position in Australia, New Zealand is much less well placed. And it's certainly not a business that has come to our attention on the basis of its performance or value.
Okay, let's go to an email now. And Kathy writes, Having recently withdrawn money from a term deposit, I would like to invest in the share market outside of my self-funded superannuation. I guess we're all self-funded to a certain extent, aren't we?
We are.
I assume she means self-managed.
Yeah.
I'm attracted to Hills Holdings Limited due to the high dividend, but concerned with its poor performance for several years. The current price of $8.65 looks attractive to the 52-week high of $1.24. What? 86.5. What does the panel think of this company? Kathy from Adelaide. Tim, anything to add to Howard's comments?
Kathy, firstly, good on you for taking more control of your financial affairs. That's a great thing to do. Seeking out companies on the basis of dividend yield it's a legitimate strategy, but it's not a very good one. And in particular, what you need to be wary of is a company that has a high dividend yield, but like this one, has poor performance and an inability to sustain or grow that dividend. You should be much more concerned about the performance than the dividend per se, and I would encourage you to be guided by that underlying performance and growth potential more than anything else, and to probably stay away from Hills.
All right, let's go to Joe from Sydney. Joe, you there?
Yeah, hello.
Hi, fire away, mate.
Yeah, look, I'm just looking at a small cap share like Central Petroleum, and I'm sort of keen on Richard Cotty. He made me a few dollars Queensland Gas, and I see that Patterson's have put out a 38-cent target price on it, and I'm thinking it might have just turned a corner. I'm wondering what you blokes think.
Thinking of dipping the toe in the water. Tim, Central Petroleum. Looking at that charts, bumped along the bottom, a couple of legs up, giving back a bit of those gains at the moment. A bit hard to read that one, but I wouldn't say it's looking too flash. What do you think?
I mean, from our point of view, it's a business that doesn't make any money at all. We can't value it. It's got large negative cash flows, and I can't even see any broker forecasts to suggest that the imminent future is bright. So I should say I can't value it. I don't know much about it. The broker's note you've got is a better informed source of information on this one than I am.
Our next caller is Ken from Brisbane. Ken, are you there?
Yes, thank you. Could the panel tell me their opinion on Aurora oil and gas, please?
Certainly. Are you on board this one, Ken? Or are you looking to get in?
No, I haven't got it. I just looking at it, and it looks interesting.
Okay. Tim, any thoughts on the oil and gas industries at the moment?
Well, a few thoughts on Aurora. It's actually one that we have a small holding in Aurora in the Montgomery fund, and it's US based. It's focused on unconventional oil and gas in North America. And the thing that attracted us to it is that on valuation grounds, it's expected to ramp up production tremendously over the next few years. It's already profitable, and the expectation is as they ramp up production, it will get a lot more profitable. They've recently announced some slightly disappointing progress in the development of their assets, and we're having a close look at that to work out how we feel about the longer-term prospects. So we're a little bit on the fence on this one at the moment, but if it is able to deliver what is expected of it, then it's potentially quite interesting.
All right, let's go to Brett from New South Wales. Brett, you're late tonight, mate. You've been at your mum's place again.
How'd you know?
Yeah, there you go. Every third Thursday, isn't it?
Mine's regarding Perseus Mining. I'm pretty sure someone from the team Montgomery was talking about it or tipping this one a while ago.
Okay.
And it's come to pretty much its lowest price, a gold producer out of West Africa. If I can just have Tim's opinion, because I'm pretty sure they cover it, yeah.
Yeah, certainly. I think, in fact, that might have been David Buckland that was talking about Perseus a few weeks back. But, yeah, Tim.
David Buckland, if you're watching, dial the number on your screen and give us 30 seconds on Perseus. It's not one I'm very familiar with, Brett. It's not one that has come up on our shortlists in recent times. I'm just having a look on Scaffold, and it does look like it's a business with a sensible balance sheet and some good growth prospects. Based on analyst forecasts, the valuation rises quite sharply in years to come. But I'm afraid I don't have the expertise to give you much more than that at the moment.
Leslie from Sydney. Leslie, you're there.
Yes. Evening, gentlemen.
Good evening.
I'd like to ask the panel about DWS.
and what their thoughts are now after they reported recently.
DWS, what do you think?
Look, very similar story to Howard. It's one that we did own in the Montgomery fund for a period of time because it does have a lot of attractive features about it. We had a close look at it a number of weeks ago and we decided to exit that position, and the reason for that was the one that Howard identified. We just couldn't see that there was the growth there to justify continuing to own it. And we were a bit concerned about the operational leverage in the business, as it relies on utilisation, and we thought we saw the potential for utilisation to perhaps fall going forward, and so we sold it on that basis.
Okay, our next question comes from Mike in New South Wales. Mike, you there?
Yes, I am. Thanks very much. I'm ringing about the sand miner Iluka Resources. How long before we see an improvement in the share price of that company?
That's a very good question. I guess that's I can tell from that chart that's not a very good-looking chart. And Iluka, no doubt, is one of the more favourite stocks with a lot of our viewers. We get a lot of questions about Iluka. Was a darling of the market up until the beginning of this year. And as Mike has just rightly pointed out, the share's taken a bit of a dive since then. Tim, let's start with you on Iluka. What do you think about Iluka?
Mike, to your question on when the share price might rise, I have tremendous admiration for anyone that knows what market prices are going to do in the short term. At Montgomery, there are 4 of us with 80-odd years of combined investment market experience, and not one of us has learned to do that. We can comment sensibly on value and what that means for long-term prices. And in the case of Iluka, it's a business that we've never gone near. Simply because there's so much uncertainty around the valuation. It's a commodity business, and we've seen that demand for that commodity can swing very wildly. Makes it very hard to be confident that the business is going to be worth a lot more than the price you're paying in a number of years' time. So it's not one for us.
Sure. Tim, commodity boom over? Bit more to run?
We're probably a bit more pessimistic than some on the commodity boom, but more generally, we're reluctant investors in resources companies because we feel that the risk is often very high relative to the rewards. So we apply pretty high discount rates to those businesses, and as a result, we don't end up investing in a great number of them.
Okay, it's time for another quick break, but before that, though, it is time to start up the stopwatch yet again. Tim, you're up. What are you watching? Your time starts now.
I'm looking at Cash Converters International. It's a business that a lot of people regard as a retailer of second-hand goods, but in fact it makes most of its money from financial services and in particular from unsecured personal loans, which is a business we think they're really quite good at. They've now got around 700 locations around the world, of which more than 200 in the UK. And the UK business in particular is starting to fire. Very good first quarter earnings results, and we think the potential for continued growth over a number of years to come. Code is CCB.
Nice. Welcome back to the program. If you've just joined us, Tim's stockwatch before the break was Cash Converters, and we'll just get the chart up there. And obviously, Tim was talking the stock up a little bit. That chart there, Tim, looking very good at the moment. Would you put a stop loss on that, or just let it go?
We don't really do stop losses. We watch them closely day by day, and we reassess our view on value. The reason that it's gone up recently is that for the first quarter of 2013, they've reported that EBIT will be up 40%, and we don't expect that to continue, but they have some early stage businesses that are growing very, very well. And we think that with that sort of growth, they're worth significantly more than the current share price.
Our first call after break is Bert from Melbourne. Bert, are you there?
Yes.
Fire away.
Thanks for taking my call. I'd like to ask the panel their views on AGL and Matrix, if they've got time.
Matrix, is it?
Yes.
Okay, let's go to AGL first off. One of Australia's oldest companies. So, Tim, do you want to have a word about AGL first off, then Matrix?
Look, nothing really to add to Howard's comments on AGL. Weak economics. We don't like the balance sheet, the financial performance, the valuation. It's not one that we look at. Matrix is one that we have owned in the past, and Matrix is a little bit of an interesting story. For a period of time, Matrix seemed to be performing very, very well. And I don't know if we've got a share price chart to hand, but back in 2011, which probably earlier than that chart shows, it rose really, really strongly from somewhere around $2 to around $10. But it's plummeted since then, and Montgomery owned it during that run-up, but exited in the early stages of the downturn. And the reasons for that were we saw problems with the cash flow not seeming to reconcile with the accounting earnings, which is always a bit of a warning sign. But more importantly, they didn't seem to be getting orders, which is obviously a bad sign in terms of revenues and earnings down the track. And so it's been quite a long time since we were in Matrix, and more recently the financial metrics haven't looked good. They haven't looked good for some time, so it's not one that we have taken much interest in over the last period of time.
All right. Let's go to another email now, and Rob writes. The share price for Echo Entertainment and National Bank have both just reached my exit point. Does the panel agree that now is an appropriate time to sell these two stocks? Thanks, Rob. NAB, getting a lot of flack recently. Tim, Howard just made a good point there about underperformance of stocks. I think every one of the other four majors has seen the stock rally for between 50 to 100% over the last 10 years, whereas NAB, I think, is off about 30 or 40%.
Yeah, NAB...
Too late for Cameron Klein to turn it around?
NAB has a long track record for misadventure, and I think Warren Buffett, I think it was, that said that when a business with a reputation for poor economics meets a manager with a reputation for good management, it's the reputation of the business that survives intact. I think something the size of NAB, it may take more than Cameron Klein to turn it around. I fear it looks like it's close to fair value, but with that track record, it's not a business that we're attracted to.
Tim, speaking of fiscal cliff, the last time we had this situation, we saw this sort of sabre rattling and brinkmanship going on to the 11th hour. They finally signed a deal. Are we going to see a repeat of the same thing again? I mean, the Republicans have probably still got their nose out of joint, not getting into power, that sort of thing.
I think it would be surprising to see the Republicans and the Democrats between them sort of plunge the economy into recession when it's completely within their power to avoid it.
Yeah.
If there is continued uncertainty and share prices fall as a result of concern around that, then we'd probably see that as a good thing. It's an opportunity in the long term.
Mm-hmm.
I think it's a brave person that makes a call in the current circumstances, though, about where the market might go in a short time frame because of that uncertainty.
Yeah.
Longer term, it's probably not a bad time to be looking for good companies that will prosper under a range of economic conditions.
Mm-hmm. Yeah. All right. Okay. That's all we have time for today. Thank you so much to our guests, Howard Coleman from Team Invest and Tim Kelley of the Montgomery Fund. And to you, our viewers, for all of your calls and emails. Until next time, I'm Mark McCarthy.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.